Most people don't retire early because they lack money. They retire late because they never understood the math. Think about that for a second. You've been working for 20, maybe 30 years. You've saved something. You've planned something. But deep down, there's this quiet fear. Like you're running a race without knowing where the finish line is. And nobody around you seems to know either. Your financial advisor shows you charts. Your coworker talks about 401k percentages. Your brother-in-law bought rental properties. And you're sitting there thinking, is any of this actually working? That's not a money problem. That's a math problem. And today, we're going to fix it. There's a number that changes everything. Not your salary, not your savings account balance, not the value of your house or your 401k statement. A different number. One that most people never calculate. One that, once you see it, you can't unsee it. It's called your FI number, your financial independence number. And it's the only number that actually matters when we're talking about retiring early. Here's how it works. Take what you spend in a year. Everything. Mortgage or rent, groceries, utilities, insurance, the dinners out, the vacations, the things you tell yourself are small. Add it all up. Get honest. That's your annual expenses. Now multiply that number by 25. That's it. That's your FI number. If you spend $60,000 a year, your FI number is $1.5 million. If you spend $40,000, it's $1 million. If you spend $80,000, it's $2 million. Simple math, but most people have never done it because nobody sat them down and said, here is the finish line. Now, where does that 25 come from? It comes from something called the 4% rule. Research from the 1990s, the Trinity study, looked at historical stock market returns and figured out that if you withdraw 4% of your portfolio per year, your money has a very high probability of lasting 30 years, maybe longer. 4% withdrawal. Flip that upside down. Multiply by 25. Same thing. And I know what some of you are thinking right now. $1.5 million? That sounds impossible. I understand that feeling, I do. But stay with me, because the math is about to get a lot more interesting and a lot more human than you've been told. Because here's what nobody explains. The path to your FI number isn't just about how much you earn. It's about the gap between what you earn and what you spend. That gap, that space, is the engine of everything. A person making $80,000 a year and spending $50,000 is building wealth faster than someone making $150,000 and spending $145,000. Income is not the variable. The gap is the variable. And this is where most people over 40 have actually been handed an advantage they don't recognize yet. You're not 25. You're not starting from zero in every sense of the word. You have something younger people don't have. You've already eliminated some of the noise, the lifestyle inflation, the trying to impress people, the spending money on things that never quite fit who you became. A lot of you are, right now, closer to your FI number than you think. Not because you're rich, but because you've quietly been learning, for decades, what actually matters to you. And that knowledge has a dollar value, a real one. The math we're doing today isn't just arithmetic. It's translation. We're translating the life you've been living into the life you're actually trying to build. And the first step is knowing your number. So before the next block, I want you to do one thing. Just one. Estimate your annual expenses. Don't overthink it. Round numbers are fine. And multiply by 25. Write it down somewhere. That number you just wrote? That's your finish line. For the first time, maybe ever, you know where you're running to. Now that you have your number, the next question is obvious. How long will it take to get there? And this is where the math gets uncomfortable. Not because it's complicated, but because it's honest. It shows you, in plain numbers, the cost of the choices you've been making and the opportunity inside the choices you haven't made yet. There's a concept called your savings rate. It's the percentage of your income that you actually keep and invest every month. Most Americans save somewhere between 5% and 10% of their income. Financial advisors call that responsible. I call it a very long road. Here's the real picture. If you save 10% of your income, you need approximately 40 years to reach your FI number. That's the standard path. Work until your mid to late 60s. Hope the market cooperated. Hope your health held. Hope you still have the energy to enjoy what you built. If you save 20%, that drops to around 37 years. Better, but not dramatically different. Now watch what happens when the number climbs. Save 30%. You're looking at about 28 years. Save 40%. Roughly 22 years. Save 50%, around 17 years. Save 60%. You could be done in 12 years. Save 75%. Some people have done it in 7 years. The math isn't linear. It's exponential on both ends. Every percentage point you add to your savings rate compresses your timeline faster than the one before it. And every percentage point you give back stretches it longer than you expect. This is the math nobody explains. Not because it's secret, because it's inconvenient. It asks something of you. It says, the timeline is not fixed. You are not a passive character in this story. Now, I'm not here to tell you to live on rice and beans and cancel everything that brings you joy. That's not a plan. That's punishment. And punishment doesn't last. But I want you to sit with this for a moment. If your savings rate is 10% right now and you found a way, a real, sustainable way, to bring it to 25%, you wouldn't just be saving more money. You'd be buying back years, actual years of your life. What would you do with those years? That's not a rhetorical question. That's the question that makes the math matter. Because numbers on a page don't motivate people. But the image of a Tuesday morning, no alarm, no commute, no one waiting for a report, that motivates people. The savings rate is a lever, and most people over 40 are in a better position to pull it than they realize. The kids might be older now. The car is paid off, maybe. The expensive decade of proving yourself to the world, that might be behind you. There's a version of your budget that doesn't require you to earn more. It just requires you to look, clearly and without judgment, at where the money is actually going. Some of it is going to things you love. Keep those. Some of it is going to things you forgot you were paying for. Those are your leverage points. And some of it, more than you'd expect, is going to a version of you that doesn't exist anymore. The person who needed that. The person who wanted that. The person you were at 32 when those choices made sense. Redirecting that money isn't sacrifice. It's just accuracy. Getting your spending to reflect who you actually are right now, at this age, with these values. That's where early retirement lives. Not in some dramatic financial overhaul. In that quiet, honest audit of what your money says about you versus what you actually believe. Let's talk about the part that actually builds the wealth. Because saving money is necessary. But saving money alone won't get you to early retirement, not even close. You could spend 30 years putting cash in a savings account and still end up working until you're 70. The engine isn't saving. The engine is compounding. And I know you've heard that word before, compound interest. Everyone's heard it. But hearing it and actually feeling it, those are two very different things. So let me show you what it looks like in real life. Let's say you're 45 years old. You have $200,000 invested in a diversified index fund. You add $2,000 a month. The market returns an average of 7% per year, which is a conservative historical estimate after inflation. In 15 years, at age 60, you don't have $560,000. You have roughly $4.1 million. The market didn't just grow your contributions, it grew itself. It grew on top of its own growth. That's the mechanism. And the longer it runs, the more violent, in the best possible way, it becomes. But here's the part that stings a little. The people who benefit most from compounding are the ones who started early. And if you're listening to this at 45 or 50 or 55, you might feel like that ship has sailed, like the best years of compounding are behind you. I want to push back on that, gently but firmly. Because there's something that changes the equation at this stage of life that younger investors simply don't have. And it's not money, it's clarity. A 28-year-old investor is making decisions for a future self they can't quite imagine. They're guessing at who they'll become, what they'll need, what will matter. They change careers. They get married, divorced, relocated. They make emotional decisions because they don't yet know themselves well enough not to. You've done most of that already. You know what kind of life you want. You know what keeps you up at night and what actually makes you happy. That clarity, when applied to an investment strategy, eliminates an enormous amount of expensive mistakes. The investor who stays the course through a market downturn because they understand their own risk tolerance, because they've lived through enough to know the world doesn't end. That investor outperforms the one who panics. Every time. Emotional discipline has a dollar value, and it compounds too. So where does the money actually go? For most people in this situation, the path is simpler than the financial industry wants you to believe. Low-cost index funds, funds that track the total market, or the S&P 500, have outperformed the majority of actively managed funds over long-time horizons. The fees are lower, the complexity is lower, the results, historically, are better. Max your tax-advantaged accounts first. Your 401k, especially if your employer matches. That match is an immediate 50% or 100% return on that portion of your money before the market does anything. Never leave it on the table. Then your IRA, Roth if you expect to be in a higher tax bracket later, traditional if you expect lower. After that, a regular brokerage account. Simple, accessible, flexible. That's the structure. It's not glamorous. It doesn't have a catchy name or a charismatic guru behind it. It's just math, working quietly on your behalf, every single day, whether you're watching it or not. And that's the thing about compounding that nobody tells you. It doesn't need your attention. It doesn't need your anxiety. It doesn't need you to check the app at 11 p.m. or read every financial headline or worry about what the Fed is doing this quarter. It just needs time. And a hands that stay steady. You bring the steadiness. The math brings the rest. There's a wall nobody talks about. You've done the math. You know your FI number. You're saving aggressively. Your investments are growing. And then someone asks you, but how do you actually use that money if you retire at 52? And the room gets quiet. Because most of the money people save for retirement is locked inside accounts designed for people who retire at 65. Touch it before 59 and a half, and the IRS charges you a 10% penalty on top of regular income taxes. So what's the point of retiring early if you can't reach your money? This is the question that stops a lot of people, and it's a legitimate one. But there are answers. Real, legal, tested answers. And they've been sitting in the tax code the entire time. Let me walk you through the main ones. The first is something called a Roth conversion ladder. Here's how it works. When you retire early, before 59 and a half, you start converting money from your traditional 401k or IRA into a Roth IRA. You pay income taxes on what you convert, but no penalty. Then, 5 years after each conversion, that money becomes completely accessible, tax-free, penalty-free. The key is to start the ladder early enough. If you plan to retire at 52, you begin converting at 47 or 48. By the time you retire, the first rungs of the ladder are already accessible. Each year, another rung opens up. It requires planning. It requires patience, but it works. And for people who have significant money in tax-deferred accounts, it's often the most powerful tool available. The second option is Rule 72T, also known as SEPP, substantially equal periodic payments. This rule allows you to begin taking distributions from your IRA before 59 and a half, penalty-free, as long as you take them in equal amounts over a fixed schedule, at least 5 years, or until you reach 59 and a half, whichever comes later. It's less flexible than the Roth ladder. Once you start, you're committed to the schedule. But for someone who needs income immediately and doesn't have 5 years to wait, it's a real option. The third, and often underestimated, tool is simply a taxable brokerage account. This is money outside of any retirement account. No age restrictions, no penalties. You invest it, it grows, and you can access it whenever you want. You pay capital gains taxes on the growth, but at long-term rates, which are significantly lower than ordinary income rates if you've held the assets for more than a year. For early retirees, the strategy often looks like this. Live off the taxable account first, in the years between retirement and 59 and a half. Let the tax-advantaged accounts keep compounding untouched. Then, when the door legally opens, shift to drawing from those. Meanwhile, the Roth ladder is running in the background, building, opening up, year by year. None of this is complicated once you see the structure, but it requires you to think in sequences, not just balances. It requires you to look at your money not as one pile, but as several, each with its own rules, its own timeline, its own purpose. That's the real financial literacy that changes outcomes. Not stock picking, not market timing, not finding the next great fund. It's understanding the rules of the game well enough to route your money through the system efficiently. The people who retire early aren't smarter than you. They're not luckier, most of the time. They just learned this architecture before most people knew it existed. They planned around the wall instead of walking into it. And now you know it exists too. Which means the wall just got a door. Here's the assumption buried inside every early retirement plan. And if you get it wrong, nothing else works. It's this, that you actually know what your life will cost when you stop working. Most people guess. They take their current expenses, subtract the commute costs and the work wardrobe and the lunches out, add a little for travel, and call it a number. And that number becomes the foundation of the entire plan. But life at 55 doesn't look like life at 45 with fewer work expenses. It looks different in ways that are hard to predict, and some of them are expensive. Let me be specific. Healthcare is the one that hits hardest. While you're employed, your company absorbs a significant portion of your premium. The moment you leave, that disappears. If you retire at 52 and Medicare doesn't start until 65, you have 13 years to bridge. A couple in their early 50s can pay anywhere from $1,200 to $2,000 a month for private health insurance, sometimes more depending on the state and the plan. That's $15,000 to $24,000 a year. On top of everything else. Did your retirement math include that? Honestly? There's also the spending pattern that almost no one anticipates. Research on actual retiree spending shows what some call a retirement smile. Expenses are higher in the early years, when you're active and traveling and doing the things you deferred. They dip in the middle years, when life quiets down. And then they rise again at the end, driven by healthcare and long-term care costs. So it's not a flat line. It never was. The 4% rule, the foundation of the FI number we built in Block 2, was designed for a 30-year retirement. If you retire at 52, you might need that money to last 40 or 45 years. The math still works, largely. But the margin for error gets thinner. Some researchers suggest that for very long retirements, a 3.5% or even 3.25% withdrawal rate is safer. That changes your FI number, not dramatically, but meaningfully. At 3.5%, you multiply your annual expenses by 28.5 instead of 25. That same $60,000 lifestyle now requires $1.71 million instead of $1.5 million. More runway, more buffer. And then there's inflation. Not the dramatic, headline-grabbing inflation of the last few years, the quiet, steady kind. The kind that turns $60,000 of purchasing power today into something noticeably smaller 20 years from now. Your withdrawal strategy needs to account for this, which is why simply holding cash is not a retirement plan. It's a slow erosion. None of this is meant to discourage you. I want to be clear about that. This is meant to make your plan durable. Because the difference between a plan that works and a plan that fails isn't usually the big dramatic market crash. It's the slow, quiet surprise. The expense you didn't model, the decade you didn't account for, the assumption that felt safe at the time. The people who retire early and stay retired, they planned for discomfort. They built buffers. They left room in the numbers for the things they couldn't predict. And they kept one more thing in their toolkit that we haven't talked about yet. Flexibility. Not every year needs to look the same. In a down market year, you spend a little less, delay the big trip, skip the renovation. In a strong year, you spend a little more. This kind of dynamic withdrawal strategy, sometimes called guardrails, can dramatically extend the life of a portfolio. It's not deprivation. It's just paying attention. The same way you've been paying attention to your work, your family, your health all these years. Retirement isn't a destination where the math stops mattering. It's just a different kind of math. One where your time is finally the asset. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Because what we talk about here isn't theory dressed up in charts. It's the math behind real decisions. The kind that people in their 40s and 50s are making right now, quietly, without much guidance. If that's you, this is your place. And speaking of real decisions, let's talk about what you actually do next. Because information without sequence is just noise. You now have the pieces. The FI number, the savings rate, the compounding engine, the account architecture, the spending reality. What you need now is a sequence, a specific order of operations, a specific order of operations that turns all of this into forward motion. Here's how I'd think about it. Step 1. Get honest about where you actually stand. Pull your numbers. Not the rough estimates in your head, the real ones. What do you have invested, and where? What are you contributing monthly? What are your actual annual expenses over the last 12 months? Not what you think you spend, but what the bank statements say. This single step, just looking clearly, changes more retirement trajectories than any investment strategy ever has. Because most people are operating on assumptions about their own finances that haven't been tested in years. Step 2. Calculate the gap. Take your current invested assets, subtract your FI number. That difference, that gap, is what you're working to close. Now you have a real problem with a real size, not a vague feeling of I need more money, an actual number, a distance. And distances can be measured, distances can be reduced, distances have finish lines. Step 3. Identify your highest leverage moves. For most people over 40, there are 3 or 4 decisions that account for the majority of the outcome, not 50. Not a complete financial overhaul, 3 or 4. Maybe it's increasing your 401k contribution by 6%. Maybe it's refinancing a debt at a lower rate and redirecting the difference. Maybe it's realizing you're holding too much cash in a savings account earning 0.01% when it could be working in the market. Maybe it's finally sitting down and actually modeling the healthcare bridge so it stops being a vague fear and becomes a budgeted line item. High leverage moves are almost always simpler than people expect. They're just uncomfortable to look at directly. Step 4. Build your bridge. This is the part that requires the most customization and, for many people, the most help. The bridge is how you get from here to 59.5 without touching the wrong accounts, without triggering unnecessary taxes, without leaving money on the table. That might mean opening a taxable brokerage account today and starting to fund it. That might mean talking to a fee-only financial advisor, not someone earning commissions on what they sell you, but someone paid for their time and their thinking, to map out your specific Roth ladder strategy. It might mean realizing you're closer than you thought and the bridge is shorter than it looked. Step 5. Protect the plan from yourself. This one doesn't have a spreadsheet, but it might matter most. The market will drop significantly at some point. Your account balance will shrink in ways that feel wrong, feel dangerous, feel like a signal to do something. And the action that almost always feels most rational in that moment, selling, moving to cash, stepping back, is almost always the most expensive thing you can do to your future. Build the plan with enough buffer that you can tolerate volatility without reacting to it. Know your numbers well enough that a bad quarter doesn't feel like a catastrophe. Because it isn't. It's just Tuesday in a long game. Early retirement isn't won in the best months. It's preserved in the worst ones. Stay in the game. That's the move. I want to leave you with something that isn't a strategy. You've had enough strategies today. You have the math now. The FI number, the savings rate, the compounding, the account architecture, the bridge, the sequence. That's all yours. Take it. Use it. But before you close this video, I want to say something that the math can't say. Most people don't fail at early retirement because they couldn't figure out the numbers. They fail because they never believed, truly believed, that the numbers applied to them. That this was something other people did. Younger people, luckier people, people who started earlier, people who earned more, people who somehow knew things they didn't. And so they kept working. Not because they had to, because the alternative required them to take themselves seriously in a way that felt presumptuous. If any part of that landed, I need you to hear this clearly. The math doesn't care about your story. It doesn't care that you started late, or made mistakes, or spent a decade in the wrong career, or went through a divorce, or didn't learn any of this at 25. The math starts from where you are, right now, today. And where you are, if you're honest about it, is probably not as far from the finish line as it feels. The gap between where most people are and where they could be isn't money. It's a decision. The decision to look clearly, plan honestly, and trust that the same discipline that got you through everything else in your life is sufficient for this too. You've already proven you can do hard things. Quietly, without applause. This is just one more hard thing, with a very clear payoff, a Tuesday morning with no alarm, coffee at your own pace, a day that belongs to you. And the knowledge, not the hope, the knowledge that tomorrow looks the same. That's what the math is actually building. Not a portfolio, a life. If this video gave you something real today, share it with 5 people who need to hear it. Not 5 random people. 5 specific ones. The friend who keeps saying they'll start saving next year. The sibling who doesn't think retirement is possible for someone like them. The person in your life who is working too hard for too long on a plan they've never actually written down. Send it to them. That's how this kind of information travels. Not through algorithms, but through people who care about each other. Subscribe to this channel if you haven't. We do this every week. Real math. Real decisions. No noise. And leave a comment below. Not just to tell me what you thought, though I genuinely like to know, but to tell me what you want us to cover next. What's the question you haven't been able to get a straight answer to? What's the number you're afraid to calculate? What's the conversation you've been putting off having with yourself? Write it down. I read them. and I'll see you in the next one.